my name's 𝗏𝗏𝗵𝗶𝗯𝗯𝗹𝗲 and I'm the fund manager for the Schroders Absolute Return Income Fund, and welcome to our quarterly update. The Schroders Absolute Return Income Fund is available as a fund on most platforms, plus it's available on CIBO. The ticker's 𝗶𝗂𝗁𝗍. So just to give a quick recap on the fund, our objective is to deliver returns of 2.5% before fees over the RBA cash rate by investing in predominantly global investment grade credit and managing the credit risk and interest rate risk and currency risk that comes with that to generate those returns. Now over the quarter, it was a very interesting quarter, a little less volatile than the June quarter, but what we're showing here on this first slide is the change in what the market thinks is going to happen to central bank policy about 3 months, 6 months and 1 year forward. And it looks at what we're expecting to happen at the end of June compared to what we're expecting to happen at the end of September. So the dotted lines are in June and the solid lines are in September. And there's a couple of interesting things that happened over the quarter. Interestingly, expectations for the US Federal Reserve were for more rate cuts to come over the next year. So the 1 year policy rate was moved down from 3.18 to 3% in terms of expectations over 1 year. And that's because the US labour market was pretty weak over the September quarter. The number of jobs growths declined from well over 100,000 per month to around 15 to 30,000 per month. And so that's made the market expect more rate cuts to be priced to happen by the Federal Reserve over the next year. The Federal Reserve did cut rates in response to those weak data and in the quarter. So in September they cut rates by 25 points. The opposite happened in Australia and Europe, where rate cuts were priced out of the market. We still expect rate cuts to happen in Australia, the market does, but the amount of those rate cuts has been reduced. So at the end of June, we had rate cuts of about down to over 1 year down to 2.9. That number is now at 3.2. Why has that happened? Over the quarter, we had generally much better than expected data, so economic activity is improving. The Australian consumers responding to real wage gains, they're responding to rate cuts, and there's a really big wealth effect happening in the Australian economy through house prices and superannuation. So consumption's really picked up. So that's the good news. The bad news is inflation seems to have stalled. The monthly number for inflation in August was a little higher than what the RBA would have expected or liked, and that's really made the market think about how many rate cuts will be needed in the next year. And so we're now pricing in about 1.5 rate cuts to a terminal rate of about 3.2. In Europe, the ECB has cut rates much quicker than most economies. They got down to 2% pretty quickly from over 4%. The ECB is now firmly on hold. So any rate cuts have basically been priced out of the European yield curve. The ECB is expecting fiscal policy from Germany to particularly pick up the economy in the next year. So the 1 year terminal rate's basically at the cash rate now for the Eurozone. So moving to our next slide, what impact has those changing expectations had on yields at both the 10 and the 2 year part of the curve over the quarter? So as you can see, in 2 year yields, they've generally increased over the quarter, as both in Europe and Australia, as those rate cut expectations have come out of the market. But in the US, 2 year yields have fallen. So you can see the yield spread between Australia and the US has narrowed significantly. Now it's flat. So it used to be about 50, 60 basis points lower, Australian 2 years. Now they're about flat. So that's quite significant change over the quarter. In 10 years, the yields have basically been flat over the quarter. So the big response has been in the 2 year part of the curve. 10 year yields flat over the quarter. But interestingly, Australian 10 year yields are now above US 10 yields, where at the start of the quarter, they were about 10, 15 basis points below. Now they're 25 basis points above. And German or European 10 yields are generally trended higher over the period. In terms of the other risk that we take in the portfolio, which is credit spreads have done really well over the quarter. You can see the chart on the left that the spread, the extra return you get from investing in corporate bonds over government bonds, that extra return has declined over the period. So that spread's come in, so that risk premium's declined. But they're getting to really low levels now, historically low levels in the case of US and Europe, and they've pretty much flatlined over September. And they're getting to quite low levels and you can see, Australian credit spreads are looking much better relative value compared to those in Europe and the US. The Australian dollar has benefited from the better outlook for the Australian economy. And so the Australian dollar is generally appreciated against both the US dollar and the yen. It's declined slightly against the euro. So the Australian dollar has benefited from interest rates moving higher in Australia relative to US, where they've moved lower. So looking forward, what are we expecting next year in terms of growth and inflation for across the globe for next year? So the top section of this table, in the green section, is growth, our growth expectations, and the bottom section is our inflation expectations. As you can see, for 2026, our most recent forecasts are all up, so they're all higher. So we're really expecting the global economy to grow stronger next year, responding to all the rate cuts that have happened across the globe in the last 12 months. So stronger growth due to those lower rates and easier financial conditions. But also, inflation is going to be higher, particularly in the US. We've got inflation moving up from about 2.8 now to 3.3. And that's well above consensus, which is looking for inflation to be flat. And that's really critical for our outlook for bond yields. In Australia in particular, we can see growth is really rebounding now. On the left-hand side chart, we've got GDP and the NAB forward order, so the NAB Bank Forward Orders Index, and you can see it leads the growth forecast, and that's been increasing since about September last year, and that's now looking for really positive growth in the economy. And on the right, what we've had this rotation from government spending to households. As I mentioned earlier, households are really responding to higher wage growth, real wage growth, and the rate cuts that we've had. And you can see the last 3 quarters, the dominant component of our growth has been households rather than the government, and that's really important. So really good signs on the Australian economy. Then when we look at inflation, you can see house prices have really picked up in anticipation of those rate cuts. So house prices are up about 10% year on year. And then inflation does look like it's troughed at that 2.5% level and may start picking up in line with that growth next year. And that may prevent the Reserve Bank from cutting again. So we think the Reserve Bank's on hold probably for the rest of this year and may have a window to cut rates again early next year. So what do those changes mean for our portfolio positioning? The main change we've made over the last quarter is we've significantly reduced our duration risk. Our interest rate risk has basically been travelling between 1 and 2 years, and we're now below 0.5, so under half of year duration. And that's because we think we're either at or very close to the trough in interest rates for this part of the cycle, and we want to reduce our duration exposure because of that. A key feature of our portfolio over the last 18 months has been a large exposure to Australian government bonds or Australian credit bonds less than 5 years to maturity, as they are the most responsive to interest rate cuts by the central bank. So we've now actually moved short duration in that part of the yield curve. So we've got a negative duration where the portfolio benefits from rises in yields, but we've offset that mostly with a long position in 10-year bonds. The Australian yield curve is still very steep, around about 82 basis points between 2 and 10-year bonds. That's steeper than most other developed market yield curves, and we expect that curve to flatten. So we want to gain from that flattening position. In terms of credit, you can't see it here on the chart, but we've reduced our credit risk by moving up the quality scale. So we've been selling out of subordinated bank debt and BBB bonds, and we're moving into higher quality senior credit bonds, rated A and AA. And that's because we think that with the yields so low, those spreads so low, that we can see that there is a potential for that to widen as the market's priced in less rate cuts both in the US and Australia than what's currently factored into markets. So we've reduced credit risk in the portfolio. We have built up our position in residential mortgage-backed securities to about close to 30%. There's a really nice dynamic working in that part of the credit market where borrowers are paying down quickly their mortgages, house prices are going up, so the collateral under those loans is increasing in value, but the loan value itself is falling. So that's a really nice dynamic, so it's improving the quality of those bonds, and they've performed really well. On the currency side, you can see we've moved to a very low foreign currency position, almost flat. And then that's in response to the Australian dollar doing quite well over the quarter. The Australian dollar should do better as the Australian economy does well, and you can see from our growth forecast next year, as the global economy does well, the Australian dollar generally does pretty well too because of its commodity cyclicality. And so if that's the case, you really don't want to have too much foreign currency in your portfolio. So we've reduced that down to pretty much minimal levels. How did we do over the quarter? Well, we added about 1% pre-fees over the cash rate by managing that interest rate risk and having that exposure to subordinated bank debt, which did really well. So the main contributors were subordinated bank debt, the spreads coming in, and also yield curve exposures, where we've been moving that yield curve position away from shorter term bonds, which moved up in yield, and into longer term bonds, which generally perform better. And then over the year, you can see that every component of our process has added value. So, we're up about 2.5% over the cash rate before fees, and every single component's added value. So that's really good. We've made money out of credit compression, we've made money out of duration risk, yield curve, and even foreign currency has added value to the portfolio. So this gives us a really strong, having lots of sources of added value or alpha builds a really robust process and performance. So over the 1 year, we're well above our target. And over 2 years, we're well above our targets as well. And so in summary, we generally think the global economy is going to do well. Next year, our growth forecasts have moved up. We are concerned about inflation, particularly in the US, picking up and maybe here. So we have moved from neutral to negative on duration. Hence, we've got that duration exposure pretty low. And we've also moved more neutral on all our credit exposures because those spreads are pretty low and they may start to widen as that inflation picks up and the amount of rate cuts that are priced in the market gets priced out. But as always, we are looking at the risks to our base case, and our portfolios are very liquid, and we can change exposures pretty quickly if that base case changes. And thank you very much for your time.